You've invested a lot of money into mutual funds, and now when you're near your retirement, your financial advisor tells you that you need to keep rebalancing your portfolio, which means sell the equity portion, move into the debt portion, and for that, you will have to book the profits and pay the capital gains tax. And most importantly, decide the new asset allocation. Most people either don't do it or they keep delaying because they don't know exactly where to invest. That's why SEBI introduced a completely new mutual fund category called life cycle funds. Now, what happens is these mutual funds, when they start with higher equity because your goal is very far away. Then every year, the equity portion keeps reducing and the debt portion keeps on increasing, and your allocation is moved into safer assets. So, by the time target year arrives, your entire investment portfolio has moved into safer allocation. So the biggest advantage is you don't have to sell anything. You don't have to do the rebalancing yourself. The fund manager will do this on your behalf. And also, because this transaction happens at the fund level, the investor does not have to bear the capital gains tax every time the allocation changes. So if your target of investment maturity matches with the life cycle of this fund, for example, if you are planning for retirement and know that you will require those funds in a particular year, or if you are planning for your child's education for which the target year is very clear and that goal is 15 to 20 years away, then this mutual fund category is definitely worth looking at. However, one has to note that this is a brand new category of investments, and secondly, investor has no control over the asset allocation of those mutual funds. Those decisions will be taken by the fund manager at his level, and you will not be aware of the asset allocation made by him. So it will remain subject to the volatility in the equity or the fluctuations in the interest rates. Also, don't forget to check the exit load on these mutual funds. It might range between 1 to 3% and compare it with your other mutual funds. So check the glide path, expense ratio, exit load, and whether the target year actually matches with your own target as per the financial goal. So would you trust a fund to manage your retirement journey automatically, or would you rather balance your portfolio yourself? Tell me in the comment section.